Hi, I'm Trey Booth, and today I want to talk about an important concept, the difference between wealth and money. For those of you who joined our recent Investors Insight presentation, you may remember we covered this in great detail, but it's such an important idea that I wanted to share it more broadly. So let's start with the simple question, what is wealth? Wealth is what you own. It includes things like your home, your car, and your investments. And building wealth is a great thing. It's really the foundation of our economy. But here's the key distinction. You can't spend wealth directly. To spend it, you have to first convert wealth into money. And that's where this concept becomes really important. Let's take a simple example. For many Americans, a large portion of their wealth is tied up in their home. If you decide to sell your house, maybe you're downsizing or want to move near the grandkids, you typically convert that wealth to money without much trouble. You hire a realtor, you put it on the market. You might look at a site like Zillow and see that your home is worth around $500,000. You list it for sale, and reasonably you should expect to receive something close to that amount. That's easily converting that $500,000 worth of wealth into money, no problem. But now imagine something different. What if everyone on your street decided to sell their home at the exact same time? Suddenly there are far more sellers than buyers, and that $500,000 of wealth can start to decline quickly. So now let's zoom out. In the US, there's roughly $180 trillion worth of wealth, but only about $20 trillion of actual money. That gap isn't a problem. In fact, it's part of what drives innovation and growth in our economy. But it can become a problem if something causes people en masse to try to convert that wealth into money at the same time. When that happens, prices can fall quickly as wealth values move closer to the available money in the system. So what can investors do about this? First, it's good to maintain a cash reserve or liquid or cash-like investments. That way you're not forced to sell long-term assets at the wrong time. Second, be mindful of a potential catalyst, events that might cause widespread selling. And third, have a long-term financial plan, because ultimately the goal is to give yourself the confidence to ride through these periods without feeling pressure to convert wealth into money at the worst possible time. I hope you found this information helpful. Please reach out to us if you have any questions or would like to talk to us about it in more detail. Thank you so much. Have a great day.